Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats.com, and it's a pleasure to be with you again this Thursday, August 29th. A lot happened, or a lot has happened since last Thursday's show. So I thought we'd talk a little bit about that first, summarize a couple of things that I think everyone needs to be aware of. And what we're going to do during today's show is take a look at what has changed in the market since last Thursday, and also given some of the recent changes, and I'll talk about that more during the show. But first up, last Friday was a big day. We had the Fed in Jackson Hole, Wyoming for the Economic Symposium. And of course, along with that meeting, we always get the Friday speech from the Fed chief. And I'm going to call him for today. I'm going to call him Jackson Hole Jay. If you know anything about the weather on the East Coast, and Puxatawny Phil comes out, and if he sees his shadow, then you got 6 more weeks of bad weather. Well, a couple of years ago, Jackson Hole Jay came out, spoke. I think he saw his shadow, and we had 6 more weeks of bad market weather, and I'll show you that in just a second. But anyway, it was different this time. So last Friday, Fed Chief Powell came out and indicated that it was time for the Fed to change its policy. So if we don't see a rate cut in September, then I think probably someone's going to need to point out the Webster's Dictionary for Mr. Powell and maybe turn it to the page that talks about transparency. Because at this point, I think it was pretty transparent that the rate cuts are coming. And so the show today is going to be all about what's happening, how rotation has been taking place heading up to this point, up to the Fed meeting, the Jackson Hole speech last Friday, and then what's been happening since then. We got our second reading of Q2 GDP out this morning, and that was a little bit hotter than expected, came in at 3%, whereas market was expecting 2.8%. That was the first quarter, or the first reading of the second quarter. But the PCE came in hotter than expected. So we had a little bit better growth, but we also had a little bit more maybe inflation concern. Is that going to impact what Fed Chief Powell thinks and how the Fed acts in September? I don't know, but based on what he said, I would think that he's going to stick to his word and we're going to have a rate cut. But I wanted to point that out as well. So let's take a look, first of all, back 2 years ago. So let's go down memory lane here. And this was the speech from Jackson Hole. This was on August 26th of 2022. And of course, we were in the midst of that cyclical bear market. I thought the bottom was in June. We started to rally nicely. And then Jackson Hole Jay came out of his Jackson Hole and apparently saw his shadow, said more pain ahead. And you can see the next 6 weeks of bad market weather that ensued. But that then did mark the bottom in October. And then we've enjoyed a pretty good market since. So now I think we're in a much different position. First of all, we're not in a cyclical bear market. So that's good news. And I think we're poised to go higher. But what is going to lead the market to the upside? I think that is going to be the key. Now, when I talk about going higher, I'm talking about the balance of the year. I'm talking about 2025. I'm not necessarily talking about the next 2 weeks or 4 weeks or 6 weeks, because we are heading into September, which is the worst calendar month of the year historically. And that dates back all of the research that I've done back to 1950. So September, we know, is not a great month, but I do see rotation taking place. So let's talk about that for a couple minutes. First off, this is the 6 major indices and the 11 sector ETFs that I like to look at over the last week, just kind of show you what's changed. Leader, IWM, that's the small cap index. So the Russell 2000 leading the action over the past week. And that is essentially since that 10 a.m. speech from Fed Chief Powell talking about the change in Fed policy. It's time to change the Fed policy, which means going from hawkish to dovish. And so, as I would have expected, and as I've been expecting all year, once rates start to come down, I think that's going to benefit small caps. We saw it again last week. So that's probably point number one to take away from what's happening in the market. Small caps starting to show some relative strength. Also, financials, industrials. These are aggressive areas of the market, but they're also a little bit more value oriented. A lot of dividend payers in here, maybe companies that don't, their earnings don't go all over the place. They're a little bit more consistent with their earnings, but they've been overlooked in the market for the last few years. And as a result, on a relative basis anyway. And so I think we're starting to see some of that money rotate as well. If we go down to the bottom, or if I just click this percentage change, we'll see the areas of the market that did not do so well last week. Consumer staples, technology. So we've got 18 different indices, sectors right here. And in 17th place is technology. So, and look right beneath NASDAQ 100. So we're talking about some of the aggressive areas, some of the areas that have led this secular bull market really since 2013, with just a few different periods, maybe where, they've taken a rest, but they're resting right now. Now, they didn't go down. You look over here and they went up. So it's not a bad thing, but they're kind of passing along the baton. That's what I get from this chart. So let's move on. I want to take a look now. This is an hourly chart that goes back 2 months. And you've got 3 blue dotted vertical lines on here. And what they are, or what they represent, the first one you'll see is on July 12th. So what was the key there? Well, if you recall, June CPI came out on the morning of July 12th. And that was the CPI report, the core CPI, that came in well below expectations. And the market immediately started saying, hey, here come the rate cuts. Now, I don't know that the market was necessarily calling for a rate cut at the late July meeting, but certainly by September, at a minimum, we were going to get rate cuts starting then. So that's the way the market interpreted it. If you look at it, you saw Dow Jones Industrial Average move up, S&P went down, NDX went down because a lot of the high growth areas dropped. And you might say, well, why would high growth drop with interest rates going down? Well, the actual rate cutting doesn't impact a lot of those large cap growth names because they're flush with cash. So they'll get benefit from perhaps a stronger economy down the road, but these rate cuts are going to directly benefit other areas of the market, like the financials, like the industrials, certainly the small caps, those small cap banks. I audited small banks when I was in public accounting for 20 years. I know what makes them tick. And they need to have that Fed funds rate lowered so that their borrowing costs go down. It also, as that goes down, you get a stronger economy. It's a better environment for small cap companies to begin making more money, which in turn means that banks, small banks, will be able to lend to those companies. So you've got the access to capital, which all of a sudden becomes a lot better for these small companies, and you've got the borrowing rate going down for the banks. So it's really a win-win. And so that's why I've been looking for many of the small companies to go up, but especially the financial area, because of the direct benefit of lower interest rates. Anyhow, S&P down. You saw there again, Dow Jones moving up, NASDAQ going down, all the way to the Fed meeting. So that's what this period is right here. We had mid caps going up, small caps going up. This was perfect. This is exactly what we talked about. The difference between the returns over that 2.5 week period on small caps versus the NASDAQ 100 was roughly about 18 percentage points. That's how much small caps outperformed back then, because it was a signal that rates were going to come down, right? All right, keep going down the list. Transports. Transports hadn't been participating. They like the fact that lower rates will be coming because transportation companies will ship more goods as the economy improves. Transports versus utilities still remaining flat. These last 3 are sustainability type ratios, or risk on versus risk off, if you will. So transports versus utilities were kind of flat, but you can see IWF versus IWD. This is the Russell 1000 large cap index versus the Russell. I don't know what the IW. It's the values. Basically, it's large cap growth versus large cap value. That's what we're looking at with IWF and IWD. So the large cap growth underperforming large cap value. So again, growth, money rotating out of growth and into value. Same thing, XLY, XLP. XLY is the more aggressive consumer discretionary. XLP is the more defensive consumer staples. Well, when this ratio goes down, it means that the staples are outperforming. So we're getting this mixture of value, defense, small is better, small, mid-size doing better than large cap. That was the theme going into the Fed meeting. And then in my opinion, a lot of people call them, for the big drop was the carry trade. I think that was partially responsible. I think maybe a bigger part was the fact that the Fed, during their meeting when they announced, said, well, rate cut, it's going to be on the table for September. Okay, that's not saying we're going to cut rates, we're going to change our policy. That's just saying, hey, it's always on the table. So I think there was a little revolt by Wall Street saying, okay, what is going on with this Fed? What do they need to see? They want sustainable inflation, a sustainable drop in inflation back toward their 2% target. Just got a great inflation report, and they're still talking about it's on the table. I don't think the market liked it. Anyhow, for the next few weeks, you can see a little bit of a change. Everything that was working leading up to the meeting all of a sudden wasn't working anymore. And so when you look at this, these are all relative. So when I look at the Dow, I'm looking at it relative to the S&P. So it outperformed the S&P until the meeting. The meeting came out and then all of a sudden underperforming again. Then you look at the NASDAQ 100. After that announcement, the CPI, core CPI being better than expected, big drop. After the Fed meeting, a little bit of recovery. All of a sudden, money moving back and away from small caps and away from mid caps, away from the Dow. And you can see that down here with the small caps and mid caps both moving lower. And there's your transports moving down. So you can kind of tell a story with these charts, which is why I don't need to watch CNBC. I don't need anybody telling me what's going on because the charts are telling me exactly what's going on. But we went into this Jackson Hole meeting, and now all of a sudden the Fed comes out and says, oh, we're ready to adjust our policy. And now that means rate cuts. I think if they don't cut, we got some issues with the Fed that we need to address. Anyhow, all of a sudden you see the Dow start to outperform. From down here, we've had outperformance in the mid caps. From here up to here, we've had outperformance in the IWM, which that's what was reflected on that the 18 charts on that chart list I showed you, where the IWM has been the best performer for the last week. Because here's where we ended last week, and here is where we are now relative to the S&P. Really nice relative performance. And the initial move was very strong, directly into small caps and mid caps. That was the initial Wall Street reaction. And so I think it's prudent to maybe start thinking about adjusting your way of thinking as you approach your trading for the balance of this year. Next chart is the same as the one I just did, except it's all the sectors relative to the S&P 500. So I want you to look at what has happened since last week. Once again, here's the technology group. Remember, I showed you they were 17th out of 18th. Well, this is a visual on a chart showing you that the XLK versus the S&P has basically been going down now for 5 days since that Jackson Hole speech. XLY, XLC, the other two aggressive groups doing the same thing, struggling. But look at industrials and financials. Here are the industrials moving up. Here's financials moving up. Now that we're talking about rate cuts again, we're going back and performing like we did when that June CPI number came out. So I think the charts are telling us a very clear story. The clear story is that they didn't know what the heck the Fed was going to do. And so every time they tried to predict what the Fed was going to do, money rotated into the smaller mid-size areas and into more value, more defensive-oriented type companies. And then when the Fed kind of bungled the meeting at the end of July and didn't say anything about a rate cut other than it's on the table, market reversed, Wall Street reversed. Now the Fed comes out and says, oh, we're going to, it's time to adjust now. Okay. I'm not sure what happened from the meeting on the 31st until August, 23rd, when he came out and said that. I mean, there's like a 3-week period. I don't know. Maybe inflation moved toward its target in 3 weeks. I don't know. Maybe it was a sustainable move somewhere in there that I missed out on. Anyway, apparently now it's sustainable. Now it's okay. Yeah, there's a little sarcasm. Sounds like it. Yeah, there is. There's plenty. Anyway, we're back to trading now, though, the way we were. So, and another way to look at this, by the way, is if we pull up an RRG. So here's an RRG. Perfect look. You can see if we go through, I'm going to just identify. I want to show you technology as we go through that peak, as we approach the peak in July, right at the top. Look at where technology is. We were going up. Why is technology not over on the leading side? Wall Street didn't want technology stocks. Anyhow, we go down. You can kind of see, watch the XLK just kind of rotate mostly on the left side of that chart as we go down, and we just pretty much just stay there, just keep rotating on the left side. Now, after the August 5th bottom, for maybe a week or so, we struggled, but now we're making a move over into the leading and kind of circling on the right side of the chart for a little bit. But now as we approach the top, watch how the technology group all of a sudden dips right back into that lagging area. That was as of that movement, that cross into lagging occurred August 22nd, right before the Jackson Hole speech. And then boom. And that's where technology now resides. So that's just another way of looking at it. Anyhow, we try to, at EarningsBeats, we have an EV Digest newsletter, which is a free newsletter that we offer to our community just to go in and check out some things, the way we look at the market. So on Mondays and Wednesdays, we issue a free newsletter. It's really just 2 paragraphs in a chart. It's not a big newsletter, but it's just an article that comes out Monday and Wednesday. We try to make it thought-provoking or educational. Anyhow, if you all are interested and you have a mobile device, you can scan the QR code that is on the slide right now, and that will take you to a landing page where you can sign up. Again, it's free. There's no credit card required. We'd love to have you. All right, so what do you do with all this information? The market is now, completely changed, if you will. It seems like leadership is rotating. So what do you do? Well, we do a lot of research, and we use the platform at Stockcharts. And so one of the keys for us, and one of the tools that we really love to use at Stockcharts is the ChartList feature. And so we do a lot of research, and we put our research into these chart lists. So for instance, I'm just going to give you a raised guidance chart list. These are companies that over the last couple of months have raised their guidance. And so we put them into a chart list. They're normally, I'll show you how I have this sorted here in just a minute, but they are they're numbered in chronological order. So the earlier numbers are going to be closer to 3 months ago. And then once companies report, like AFRM reported last night, this one this week will be removed. And if they raise guidance again, they'll go in at the end of the list, which is all the way down here at the bottom. These are going to be the more recent raised guidance. So AFRM, if they raise guidance, will come right in here at the bottom. So the old we let go of, and then the new comes in. So it's just this revolving door kind of a chart list. But at any point in time, our members can go back, pull up a chart list. If they're a Stockcharts member, they can pull up the chart list. They can annotate the chart. Well, first of all, they can download them from our website, all of our members, EarningsBeats members, if they're also Stockcharts members. If you're not a Stockcharts member, you can still pull them up and you can view them, but you're just not going to be able to manipulate them. You're not going to be able to put them in a chart list because you don't own, you don't have an account. So make sure you sign up at Stockcharts, sign up at EarningsBeats. We have a free 30-day trial. You can start to download all of our research into your account. But let me show you what you can do with this. So I just gave you all the meat that, hey, industrials look good, financials look good, small caps look good. Well, now that you have all this information in a chart list, let me show you what you can do with it. So I'm going to sort first to market cap, and then let's do industry. All right, so now what will happen is you can see on every industry group, you can see that the market cap, it's in market cap order. So once we know that industrials and financials have been leading market, in fact, rather than do industry, we can even do sector. Let's do sector. Hopefully still in order. Yes, still in order. So now I'm going to go down and I'm going to look at the financials. So here are the financials, starting there and here, there. Now, these are just companies that have raised guidance. So these are the financials that we have on our list that have raised guidance. You can see the various areas and various industry groups. But one of them that I wanted to talk about was PRG. Here it is, PRG. Now, if you go across here, you can see PRG is $2 billion. So it's a small cap, kind of on the cusp of trying to become a mid cap. But anyway, $2 billion, I'm going to call it a small cap. It's in the financial area and consumer finance. So let me show you. And by the way, PRG has a scooter right now, 95. So on a relative strength basis, it's a pretty strong company. PRG, if we pull up the chart, let me show you. Here's the AD line. Notice right when the June CPI came out on July 12th, that's when we saw the AD line take off to the upside. We later came out with earnings, but you can see we actually bottomed on July 11th, started moving up, and then we had the earnings, came back down, tested key gap support, and now we've moved back to a new high. I would continue to watch this rising 20-day moving average. And look down here, the relative strength started to move higher on right around July 10th, 11th, right before that CPI report came out, then jumped with earnings, and it has continued to go up and set a new high recently. Also, check out consumer finance relative to the S&P 500. It was going straight down. What changed in the middle of the week of July 8th? CPI report came out. So you can kind of see how things are rotating. Consumer finance, nobody would touch it. We got that June CPI report out, and now all of a sudden, this is an outperforming group, and here's a leader within the group. So that's how you can use the rotation that I showed you. Go over to some of the research that we provide, pull up the chart list, and easily pull up some other stocks. Now, I'm not going to go back and look at the chart list, but here's another stock that came from that same list, raised guidance. And once again, since early May, TRUP has been going up in terms of its AD line, but it really started to strengthen as we got into the middle part of July, which again was when we had that June CPI report come out. We also gapped up with the stock, and it looks like it was the morning of, or maybe it was July 11th. I think it was the morning before we got that CPI report, but then we had that, and that just added to it. But look at the relative strength, and then look at property and casualty insurance. Just like consumer finance, under pressure. What changed in the week of July 8th all of a sudden? June CPI. Money is rotating. And now all of a sudden, property and casualty insurance looking good. So now you got a stock, it's a small cap stock that's out of a strengthening group. It's got great AD line, so it appears to be accumulated. And then you just simply have it on this chart list, maybe move it to your own special watch list. But I would just be waiting for the stock to maybe pull back, hit a 20-day test, something that makes your timing a little bit better on the trade. But this is how we use this information. TGLS, another one from that same raised guidance list. This one's been showing a strong AD line for the last year. Prices have continued to go up. But if you look down here, what happened here? Building materials, again, under pressure until that second week of July. Gee, I wonder what happened. All of a sudden, building materials come to life at that point when that CPI report comes out. And so here's a stock that all of a sudden is strengthened. Volume trends have improved. The group is, this is a stock that's one of the leaders in the group, and the group's gotten stronger. AD line continues to set new highs. These are the types of stocks that I believe it's worth looking into now through year end, because Wall Street is already telling us a story that they are rotating. The big Wall Street firms are already rotating into some of these areas. And if you don't pay attention to it, you stick with what's been working for the last 3 years, I think you might have some trouble here over the next few months. Last thing I want to do real quick is I want to go through the Fab or the Magnificent Seven plus a couple of their friends. Here's Nvidia. Nvidia reported. We saw the gap down. Let's get an update here. Still down today, down $5, 4%. They beat top and bottom line, and they raised revenue guidance. Not good enough. They went up so much. Now the fundamentals are trying to catch up with the technicals. So I just see more and more sideways consolidation for Nvidia and also for many of the semiconductors. Moving on, let's see. Let's take a look at Apple. Go through these really quick. Apple, beautiful recovery off that August low, but still some work to do to take out the July high. You got Microsoft. Microsoft moving above moving averages, back down below, and now back up above. To me, it looks like more sideways consolidation. Recent lows are set. Support down just below 390. I'd watch that level very closely if there is any additional weakness ahead in the month of September. Take a look at Meta. So Meta, triple top, definitely double top, just above 540. Pulling back, holding its rising 20-day. As long as it holds its 20-day, we got a chance at a breakout here. Amazon, strengthening today up a little bit, but back below the moving average. So we went above, below, now above, and then back down below. Now we're trying to rally. Again, this to me kind of reeks of sideways consolidation. I do love the AD line there, though. I think as Amazon falls a little bit here, we're seeing Wall Street accumulate the stock. So I think once we get past September, I would not be surprised to see Amazon into year end performing really well. Google, really one of the weaker of the Mag 7. Haven't been able to get back through the 20-day moving average. The AD line's gone down. It's been one of the weaker performers in internet. I think this one's got a lot of work to do. I'd stay away, at least till it shows better signs. Tesla, pretty much the same thing, although we have seen some sideways consolidation. Break above the moving averages back down. Now we're trying to get back up above. I just see more sideways or rectangular consolidation here. Netflix, I love Netflix relative to the internet group. I'd like to see a couple big hollow candles on strong volume, get that AD line moving back up, because that's the only thing that really bothers me here. I see Netflix breaking out. All right, Costco and Broadcom. Costco just broke out, pulled back. That was a bearish engulfing candle. So maybe short-term weakness to the 20-day, but otherwise I see Costco going higher. The last one, AVGO, Broadcom reports earnings next week. So if Nvidia as a leader in semiconductors didn't see a move up with a beat and with raised guidance, I'm not sure how Broadcom is going to do any different. So relative strength here has been flat versus the semis for the last several months. I'm just not seeing it with Broadcom. I'd be a little careful there. Two companies that did report last night, they're having just big days today. Affirm Holdings, AFRM, big breakout there, killed their bottom line earnings per share. Still a loss. I think they came in with a 14-cent loss. Market was expecting 45-cent loss, though. So it was much closer to the break-even line. They beat on revenues. The stock obviously gapping up there. And one other stock I wanted to mention in the software space, Veeva Systems, reporting better than expected, top and bottom line, raising their guidance. And you can see a nice gap up there. Not breaking out, but this is one maybe down the road. AD line has not been very good. So maybe you have to wait a little bit for this one, but I do suspect eventually this one goes higher. All right, last thing, if you want to follow me at EarningsBeats, you can check out the slide on your screen. Again, mobile device, simply scan that QR code, take you to a page where you can follow me at EarningsBeats. All right, that's about it. Again, I think the market is holding up pretty well here. A lot of times late August and into September can be a rough period. I will say second half of September tends to be much worse than the first half. So maybe we have a couple weeks here to breathe a little easier, especially with the Fed becoming a little bit more dovish. But I still believe with the election around the corner, and if we get any kind of news that the economy is starting to weaken, that could lead to some uncertainty and maybe a little bit more selling later this fall. But I do believe that August low is the low. I don't think we go below that one. Anyway, have a great day, everybody. It was really a pleasure being with you. I'll be back next Thursday. Happy trading.